Today, I want to share with you 3 simple concepts that rapidly improved my own day trading skills. If you're anything like I was at the beginning of my day trading career, your account and emotions probably look a bit like a roller coaster. You probably had a starting balance at some point. You probably had a really good winning streak of trades that made you feel like you were on top of the world. Holy crap, I can quit my job. I can start trading for a living. And directly after that, for me, it was always followed by a losing streak that outweighed that winning streak. I felt depressed and almost like completely giving up on trading. This pattern and process lasted over 12 months for me at the beginning of my trading career until I discovered the 3 concepts I'm going to be sharing with you today. So if that sounds good, I want you to go ahead and click that like button for me. If you're brand new here, we come out with videos like this each and every week. So click that subscribe button along with the notification bell, and I'll see you directly after the intro and disclaimer. Welcome back. And just in case you're brand new, my name is Steven. I've been trading for over 10 years and I've been teaching traders around the world for over 6. I have an insane passion for giving away lessons just like this one for absolutely free. So let's go ahead and get started with day trading lesson number 1. Now, I personally trade in the Forex market. The rest of these concepts will be applicable to any financial market you trade in, but this one is specifically applicable to Forex. As you can see, lesson number 1 is to only trade pairs with historically low spreads. At the beginning of my trading career, I lost so much money without understanding the concept I'm about to show you. So spreads are nothing more than the difference between the price that you can buy an asset, like a Forex currency pair, and the price you can sell it. And what this does, you can see our spread here on TradingView in the top left. Right now, the Aussie New Zealand has a 7.2 pip spread. Now let me tell you why this is a problem. Right here you can see the price you can buy the Aussie New Zealand at. And what is that price? 1.1076. Right now I have a blue horizontal line at 1.1076. Why does this hurt our day trading? Well, as you can see, price is currently at this number, which is 1.1073. But even if we buy right now where price is on a chart at 1.1073, the close of that green candle, where we're actually buying in is price plus spread, which means we're buying in right here. Now, the reason this is detrimental to day trading is because look how bad this skews our reward to risk ratio. Now, instead of a 1.4, we're like a backwards reward to risk ratio just because of the spread. The spread also works in the opposite direction, meaning price could go down just a small amount and you could get stopped out due to the spread here on the Aussie New Zealand. Now, this spread does not necessarily affect us in a super major way if we're trading on 4-hour time frames and above. But if you're on the 1-hour time frame and below, what this does, because you're day trading, obviously you're going to have a smaller stop loss because the amount of pips you're going for, the amount of pips you're willing to lose is going to be smaller on day trading time frames. So with that being the case, what the spread does is it ends up you entering into a trade and then price going down a lot less than it has to for the actual candle to hit your stop loss, and then it stops you out. What I mean by that is if a candle printed right here and it did this, and this was a red candle, you would be stopped out even though the candle didn't touch your stop loss. And the reason is because you're trading a currency pair that has a higher spread. And this is why we want to make sure, and this is why day trading lesson number 1 is to only trade currency pairs that have historically low spreads. Now, what I'm going to do is actually show you the top 5 historically low spreads currency pairs. The top 5 currency pairs with historically low spreads. Let's go ahead and take a look at those. So right here, straight from Investopedia, these are the top 5 currency pairs that have the lowest spreads historically on average. As you can see, they are the euro dollar, the pound dollar, the dollar Canada, the dollar yen, and the euro yen. So again, I think this is one of the most overlooked parts of day trading in the Forex market is to ensure that you're trading pairs with low spreads, because otherwise your stop is going to get hit quite early compared to when you thought it was, and you're going to ruin your reward to risk ratio on your entries unless you're trading these 5 currency pairs or similar currency pairs to these that have really low historic spreads. Let's move on to the second concept that rapidly increased my day trading skills. And if you're wondering why doing this and only sticking to low spread currency pairs increased my skills is because I started losing a lot less trades when I started applying this concept. And my reward to risk ratio increased dramatically. Let's move on to concept number 2. Day trading lesson number 2 is you only want to trade based on a rules-based strategy that is proven to be historically profitable. I'll explain all that in just a second, but the reason this is the case is because whenever you first start day trading, there's a lot of information out there. You're being hit with a ton of different strategies from different YouTube videos, different lessons you see on baby pips, different versions of technical analysis, fundamentals, you need to use the news, all of this different information. And what happens is if you don't sit down and create or learn a rules-based strategy that has proven to be profitable in the past, then you're just going to confuse yourself, constantly switch strategies, trade based on different things, and that is going to cause your trading to look like that roller coaster. It's going to cause your account and your emotions to do this and eventually drop low enough for you to blow your account if you don't change it. So how do we change it? Well, as traders, we're not trading based on a feeling. We're not trading based on what we think might happen. We're not even really trading based on just technical analysis by itself. We're trading as professionals. We trade based on statistic advantages, meaning if I combine these technical factors, these very specific technical factors over and over throughout a large sample size, then that's proven to be profitable in historical data. So even though I'm sure you've seen other people and even me myself break down a chart, right? Breaking down a chart, just doing analysis, that's not how someone's profitable. You could know technical analysis, you could know how to break down a chart like the back of your hand, but that doesn't equal profitable trading. That's just being able to break down a chart. What you have to do is create consistency out of those skills. So you have the skills of breaking down a chart, right? Let's say you do know technical analysis like the back of your hand, but you're still not profitable. The reason is because you haven't created consistency around that skill. The way you create consistency around that skill is by creating a rules-based strategy based on technical analysis or based on fundamentals. It can be based on both. There's nothing wrong with combining news events and fundamental analysis of economies with your technical analysis, but you do need a rules-based way of trading that has been consistently profitable, at least through historic data, so you know it's likely to be profitable in the future. So what's the first step of creating a rules-based strategy? I do that through a process I call CEST. CEST. This stands for conditions. Conditions would be all the things I need price to do before I look for an entry reason. These would be things like I need price in trend, or I need price to be consolidating. I need price to be oversold, overbought, against a moving average, above a moving average. I need the MACD to have just crossed. All of those would be examples of conditions, right? Next up, I need to see or have a set in stone rule for entries. This is the process of building a strategy around a very objective form of rules. A very objective rule set is create your conditions you need to see before an entry. Then I also have to have an objective way I enter the market. A lot of times this might be something like a candlestick pattern. It might be a candlestick pattern followed by a green candle. It might be a candlestick pattern followed by price going above it. It could be a pullback after some type of candlestick pattern, a Fibonacci retracement. You get the point. Your entry does not matter. I'm not saying there's a perfect entry out there. What I'm saying is you better have a rule for exactly when you press the buy or sell button. Otherwise, you're going to be inconsistent and lose money as a trader. The other thing I must have is a set in stone rule for my stop loss. Where am I wrong? And when am I going to get out of this trade? That's where my stop loss needs to be. I'm not going to leave an open-ended stop loss, because at that point, you could lose your entire account on one trade. It's just silly, right? You'd like some rules for your target. At first, it probably needs to be set in stone. You need a set in stone rule for all these in order to build a rules-based strategy. Now, you don't have to go out there and try to just build one of these yourself. That takes years. There are so many different strategies that you can learn here on YouTube and then just apply CEST. You can take the concepts of whatever someone else may be teaching and just apply this to those concepts and go, okay, well, it looks like these are the conditions that need to be met. It looks like this is what they're using for an entry. Let me make that set in stone somehow with a set of rules. It looks like here's where they normally place their stop loss. How can I make a rule around that? Hopefully you're getting the point. The point is you want to have rules in place that you're trading based on, so you're not constantly switching strategies, being inconsistent with your trading. And what this is going to allow you to do is find a consistent way to place trades based on objective rules to avoid that confusion. And what's the second part of this? It has to be proven to be historically profitable. How do we do that? We do that through a process called backtesting. So how do you backtest? Well, you take these rules that you have created or learned from someone else. Nearly every strategy we teach here on this channel has CEST. It's made from that. Actually, I'll put a video in the description and in the top right hand corner of the screen. I think I called it the only day trading strategy you'll ever need. And it's literally a strategy based on this. So you'll have that already, right? But proven to be historically profitable, you want to backtest those rules. All that means is you take every one of those rules, which is considered your strategy, and you test it through historical data. Test it for the past 2 to 3 years and see out of that span of time, was what you have created profitable over that span of time? Was your strategy based on CEST? Did it make money or lose money? What was the maximum drawdown? What was the average losing streak it had? All of these statistics are things that we need as traders to help us build confidence and to ensure that what we're trading makes money over time. And I know that sounds like a lot of work, but if you don't do that and you're not willing to do that, then I'm going to tell you the absolute truth right now. You should quit trading. Because you're never going to be profitable if you're not willing to put in the work of either learning or creating a rules-based strategy and backtesting it through historic data in order to build your confidence and ensure that it's something that can be profitable or is likely to be profitable in the future. If you can't do that, then you're just not meant for trading. And that's fine. There's plenty of other side hustles out there that can make you a lot of money. It's not like trading is the only thing, but that's the work it takes to become a consistently profitable trader. But this is exactly how you fix that issue. And if you do, I promise your day trading skills will improve rapidly. Let's check out concept number 3. Before we get into number 3, it's story time. I just noticed I was editing the video and you can see this really easily. This is because I have another passion, which is cooking. And the other day I got a little overconfident and the avocado oil from the pan jumped up and bit me back. Unfortunately, it's about a 2nd-degree burn that is currently trying to heal. But now let's move on to day trading lesson number 3. As you can see, lesson number 3 is all about risk management. And what I decided, this doesn't have to be your decision. You can risk whatever you want to. It's your hard-earned money. I didn't earn it, so I'm not going to tell you how to spend it. Risk whatever you want. But what helped me avoid that roller coaster of emotions and that roller coaster in my trading was to never risk more than 1% on a specific trade in my day trading. Now, does this mean that you have to risk 1% forever and you can never increase your risk? No, but if you're starting out or if you're someone who's been struggling for a long time, until you learn how to be profitable with a 1% risk, you're not going to be profitable from just risking more money. That's not going to make you consistently profitable. It's just going to make you lose money faster. So, not as a suggestion, because this is not financial advice, but for me, if I was a struggling day trader or someone that was brand new, I would not risk more than 1% of my total account value. Now, this kind of goes into the trifecta of things we need in order to be profitable traders. So far, we've talked about strategy and we talked about the spread, right? But so far, we've talked about strategy, and strategy is definitely one of the things we need to become money-making traders. Another thing we need is what we just talked about, which is risk management. What this did, this using 1% or less of my account value per trade, is it allowed me to stop making emotional mistakes. It allowed me to stop moving my stop loss or my target based on fear or greed. It helped me to really relax in all of my trades. And being emotionless, if you haven't heard by now, is one of the only ways to really become profitable. Anyone that's trading based on emotions is going to lose money over the long run unless they just get extremely lucky. And so if you want to be a consistently profitable trader over the long run, you're going to have to learn how to control those emotions. One of the best tools we have to help us control emotions is, in fact, risk management. And not only does this help us control our emotions, it also allows us to lose less if we're not profitable yet. So you're still in that practicing stage, meaning you're either struggling or just now starting to trade. Losing money 1% at a time, trust me, I've done it the other way, which is losing money a lot more than 1% at a time. At one point, I was risking 5% of my account value. Losing at 1% per trade, losing at 1% at a time, much more sustainable, much easier to handle, not just emotionally, but for your bills, for the shit you have to take care of outside of just, I really want to trade. It's much easier to still be able to afford your apartment payment if you're only risking 1% per trade. Now, you shouldn't have money in your trading account that you need for your apartment payment, but that's beyond the scope of this video. And just to finish out this triangle with you, trading psychology is the other thing you must have. Now, this can also be known as discipline, meaning you have the discipline to stick to your risk management plan. You don't get greedy one day because you want money for that Lamborghini and decide to risk 10% per trade just because it's a Friday and I want a Lamborghini. I know that's a bit exaggerated, but you also are disciplined to the strategy you're trading, the rules of it. You're disciplined to the stops and targets, the entry reason. You don't just jump in out of FOMO because you see what you think is a trade that might hit targets. What you really need to understand about all of this is that we're not trading based on what we think is going to happen. I'm not good at trading because I go out there, look at a chart, and I can always tell what's going to happen. No, I make money as a trader because of the fact that I am patient. And I wait for setups that I know give me a statistic advantage based on rules-based strategies I've developed and tested. And I know for a fact that they're at least historically profitable, which give them a very high likelihood of being profitable in the future. So as a bonus, number 4, be patient. Oh, I'm gonna screw this up. I really hope this is how you spell patient. Don't make fun of me. Be patient. I don't just mean in looking for trades. Risk 1% or less. This sounds like advice. I would risk 1% or less as a beginner, knowing that once you become profitable, you can risk more if that's what you want to do. That's called being patient. Understand that it may take you 3 months to a year to completely master being a profitable trader, and that's okay. Be patient. 4th bonus day trading lesson. And with that said, if you want help from me as a personal mentor, mastering strategies that make money over time, your own personal risk management, and your trading psychology, then we have some space available in the TDC FX University. Feel free to click the first link in the description. In the university, you will get a full training course walking you through the process of learning all 3 of these skills in a very organized and detailed way. You also will be receiving the Pro Trader Report, which are areas in the market I'm paying attention to for the week ahead, 3 to 5 email analysis each week, which are trades I'm placing based on the strategies you're learning in the course. Yes, in the course, I teach you multiple rules-based strategies. And on top of all that, you have something called priority email if you decide to join us, which means any trading-related questions you have, you can actually email me directly, and I'll be the one responding to those to ensure that you have as smooth of a journey as possible between where you are and accomplishing your trading goals. So if that sounds good, again, it's the first link in the description, or you can go to www.tdcfxuniversity.com. If you made it to the end of the video, feel free to leave me a comment and let me know if this was valuable for you. Make sure you click that like button. Make sure to subscribe if you're new and click the notification bell, and I'm going to talk to you in the next video. See you soon.